by Professor Tom Chang. So I would like to give a short introduction, and then the seminar will be 90 minutes today. So Professor Chang is an associate professor of finance and business economics at the USC Marshall School of Business. He is also a research fellow at the Schaffer Center for Health Policy and Economics, a CESR fellow at the USC Dawnfire Center for Economics and Social Research, and also a team scientist with the Behavioral Change for Good initiative. He conducts research in the fields of behavioral economics and finance with a focus on better understanding individual decision-making and its implication for firm behavior. His research has been published in top scientific journals and also regularly covered in outlets like The Atlantic, The Economist, the Financial Times, the New York Times, to name a few. Professor Chang holds a Bachelor of Science in Physics and a PhD in Economics from MIT. So please welcome Professor Chang.
All right, great. Thank you all for coming. It's a pleasure to be here. This is a paper that kind of got derailed by the pandemic, and we started picking it back up a little while ago. So we're in the midst of revision. So comments are very much appreciated, and feel free to interrupt me at any time. The thing that got us started on this is the idea of, are things like risk a true sort of underlying primitive, or is it something that's context specific? That is, if I get more risk averse in a given situation, does that mean it's only in that situation or at that domain that I get more risk averse? Or is it like the neoclassical models would have it, it's a true primitive, so if your risk aversion changes in one domain, it changes across all domains?
Could you change?
No problem.
Thank you.
Okay. You know, there's another way to sort of look at this. The psychologists call it, well, we'll talk about the psychologists call it. So there's this paper back in the 70s where the psychologists had, there's this bridge in sort of the northwest of the United States, and as you can see, it's not a very wide bridge that you walk across. It's above this really high gorge. You know, they're sort of handrails, but it's a very scary bridge to cross. And as you go across this, the things that get even scarier are if it's raining or if it's a little windy, the bridge sways side to side, and you could expect this is a very sort of scary thing to sort of experience. And so what these psychologists had is they had the idea that being scared would affect other things. And so what they thought is like, look, when you get scared, your heart beats really fast, you get excited, you know, your palms sweat. Like, what else does that happen? Oh, when you're attracted to someone, when you're in love, all those things happen too. And so what they did is they had a nice woman, a young woman, stay here on the end of the bridge, and she would survey men as they came across. And she would either survey them right after they got off the bridge, so they were still all sort of pepped up, or they would wait until they'd walked a little bit further, and so they had more time to calm down and relax. And the survey itself was actually, it was a red herring, it was garbage. They didn't really care too much about that. But what they did care about is this woman would hand out her phone number to the men and say, you can call me if you have any questions. And the idea was that if they came across and they see this woman, their heart's beating and they get all excited, they're like, I'm attracted to this woman, I should call her. And if they're not excited, they wouldn't. And that's actually exactly what they found. If you talk to a person right when they got off this bridge and she gave them their phone number, they were much more likely to call her than if she waited 5 minutes and they're sort of back in the parking lot. So it's this idea that emotions aren't something that's specific. When you get scared, it sort of affects all your decision making. When you get sort of excited, it affects all your decision making. And this sounds to me a lot like the standard idea of sort of economic primitives, that if something gets you scared so that you're more risk averse, you'll see this effect across multiple dimensions. And so what we're going to do here essentially is we're going to kind of do something like the bridge experiment. We're going to use market conditions when the stock market goes up and down and goes crazy with volatility, and use that kind of like bridge conditions. And then we're going to see how that affects decision making. Now, the one thing we can't look at is how it affects decision making in terms of stocks, because that's going to be hard to sort of separate, because there's no identification there. They're all sort of tied together, right? So the stock market conditions on any given day are going to be not only affected, but are driven by the decisions individual investors are making. So we look for long run decision making that happens outside the stock market. And the two things we look at, we're going to look at demand for insurance, specifically life insurance, and we're going to look at the hurdle rate for loan applications. That is, we have commercial loan decisions, and we can see what loans get approved, and then we can follow the loans to see, do these loans succeed or not. So if they raise the hurdle rate, that is, they're making it more difficult for people to get loans, only the better loans should go through, and so the default rate should be lower. So the first part of this is the stock market like the bridge? Is it something that affects traders? And there's this paper I really liked by Andrew Lowe and Repin back in 2002, where they basically took like 10 traders, like professional traders, and they hooked them up to these machines that measured sort of their body's reactions, and then to watch them during the trading day. And they found that the thing that really sort of drove most of it is when the market got really volatile, even the professional traders would have heightened responses, like their heart would beat faster, their hands would get sweatier, things like that. So this is what sort of got traders, even professional traders, experienced traders, emotional, was seeing the market go up and down. So we have some evidence from the lab that this works. This last paper, there's two parts of this. They have some really neat data from a bank in Italy, and they basically find that after the financial crisis, when people got sort of primed and started thinking about financial collapse, they became more risk averse. But the part that I like that sort of fits in with this better is they had this really neat experiment. And they basically would show people in the lab one of two movies, one a sort of a boring movie, and the other they would show them a scene from a really, really scary movie. And then afterwards, they would have them make risk, decisions where you sort of get to measure their risk preference. And the people who were randomly assigned to see the scary movie were much more risk averse. So getting scared basically made you more risk averse. The other one that I sort of think about when I think about the sort of antecedents of this paper is this paper by a colleague of mine, Chris Parsons and Joy down at the UCSD, where they looked at daily stock market returns and hospital admissions in California. And they basically found that big drops in the stock market actually led to higher hospital admissions for things that you would assume are correlated with stress. Yeah. So the way I think about this is it's kind of doing these things, right? So Lowe says that stock market volatility makes people get stressed. These guys say that when you get stressed or scared, that actually increases your risk aversion in other domains. And then the Engelberg and Parsons was just like, look, let's look at daily stock market conditions and see how it affects some condition. So, the idea here is that volatility is going to increase risk aversion. And so if it does, let's think about what risk aversion means in these two contexts. So the reason we picked life insurance is that insurance is the thing you buy when things get risky. They sort of lower your risk exposure. So that's exactly the thing that when risk aversion goes up, demand should go up. And when risk aversion goes down, demand should go down. So there it's simple. If risk aversion is higher, people should buy more insurance for the same given price. The demand for insurance should go up. For bankers, risk aversion should also appear in a very similar way. They should set a higher threshold for which they say it's okay to give this company a loan. That's how risk aversion looks. It's a little bit more complicated in that how do we measure that? So what we should see is that loans approved on higher volatility days should perform better because you're getting rid of the riskier loans on the margin. The loans should look better on paper too, right? So to the extent that the bankers rely on hard information to make their decisions, we should see it in when we look at the characteristics of the portfolio of loans that get approved on any given day. And we should also see fewer loans approved. Threshold is higher, fewer things get past that threshold. Okay. So there are a few empirical challenges to doing research like this, right? The first is identification, and we'll talk a lot more about that later. The second part is going to be isolating mechanism, and we're going to talk about this a lot about this later too, is that we need to sort of think through two things really seriously. The first thing you always need to think through is maybe there's a rational reason for why this is going on, right? You have to sort of rule out the neoclassical explanation. And so the neoclassical explanation here would be some sort of learning broadly defined. That is, I'm looking at daily stock market conditions on long run things like buying life insurance. So it still could be that there's some information in that day's stock condition that's relevant to that decision. You're learning something more about the world given the stock market conditions that day. And so, that's a possibility, but it's one we could check. I don't think it doesn't seem likely to me that any single day has enough marginal information to sort of affect long run loan performance or whether or not you should buy life insurance, but it's literally something we check so we can. And the other thing is, you always worry about there's some unobserved variable that's driving both these things, right? So maybe something is driving an increase in stock market volatility that's also making loans riskier. And that's also making life insurance seem like a more attractive thing to buy. We'll talk a little bit about ways to sort of rule that out. This next one is hard. It's hard because behavioral responses are kind of easy to come up with. You can always think of some story that has to do with someone behaving in a non-rational way. And to the extent that you could always generate these stories, there's a near infinite number of these things you might have to rule out. It's the best sort of we've got here, and this wasn't even mine. We got this from other people who are nice enough to read the paper. It's the idea of distraction. So maybe the loan officer is distracted, and so they spend less time doing their job. And maybe on top of that, the thing that's hard to evaluate are these marginal loans. It's easy to see, oh, these are good loans. And it's easy to see these are bad loans. It's exactly the loans on the margin that take the most effort to do. And maybe what they do is when they see the marginal loans, they're like, I'm just going to say, no, I don't have time. And so that could look like increased hurdle rate. It's hard to reconcile that with the life insurance thing. You'll see these stories get kind of complicated, but I think we have pretty good evidence that's not distraction. But if you think of other stories, chat them out. Always happy to hear them and try to see if we can roll them out. Okay, so this project is based on Chinese data, and the reason it's based on Chinese data is twofold. The first is that stock market participation is crazy high in China, retail stock market participation. There are these centers everywhere where you just sort of, this just looks like a gambling hall to me. You just sort of go and it's like a sports book. You see the numbers run. You can go to your bookie, the dealer there, and say, what you want to buy or sell. You can just, it really looks like a horse track. Now they switched it, so instead of having to go there, you can sort of do online gambling, but you still go to a center to do it. I guess it's more exciting to have lots of people with you. And the other thing is it's really prevalent at work. Someone who knows Chinese better than me can probably tell me how I'm mispronouncing Shangban Chaogo, but it basically means trading on the job. And when we checked, Google returned 3.36 million results, Google in China, for this term, for trading on the job. And there's a recent survey that showed 94.9% of white-collar workers say that some of their colleagues trade on the job. 48% said a lot of colleagues trade on the job, and 33% that said almost all their colleagues trade on the job. This I always love. 94% of some of their colleagues work, but they themselves don't trade on the job. Only about half of them admit to trading on the job, and 20% of bosses said they have, or say they have an explicit rule banning on the job trading. This is a thing that management there is very concerned about because they think their workers are just on their phones trading instead of doing their job. So it's a very salient thing for both the people who would buy insurance and the white collar workers who are, let's say, working at a bank. The other thing is this is also where we got really cool data. So we have data from a large insurance company in China. We have life insurance, and we see the number of life insurance policies sold by city and date. And we also have detailed information on a subset of these policies, including cancellation. So we can sort of see characteristics of the policies and track it over time. For the loan data, it's again data from a large Chinese bank, one of the largest banks in China. We have data on all their commercial loans. The problem is we can't use all their commercial loans because we need to know when the loan was approved. And unfortunately, their system is kind of weird. It reports when the first disbursement, or like when it doesn't approve when it doesn't show up when the loan is approved. It shows up at some other event that happens later. There's only one type of loan, though, that fortunately we do have data on when it's approved, and it's when it's an extension. So basically, you have a loan, a zero sort of an interest-only loan that's gone over time, and then you just renew this again and again. And so for those, the system oddly does the precise date of loan extension approval. So we know when these loans were approved. And also the loans are also assigned to the workers at the beginning of the day, and they have to finish at the end of the day. So we know the date in which it was assigned and the date in which it was finished. And we have, loan performance measures for all of this. About 8% of the loans go into default, and we have firm and loan characteristics. And then we merge this with the Shanghai Stock Exchange Composite Index. So those are our three data sources. Okay. As promised, identification. There are two parts to the identification here. One is that we use high frequency data to look at long run financial decision making. So the idea there is basically there's not a lot of marginal information in any one given day's sort of financial conditions. So the stock market goes up or down one day, or whether or not the volatility is high or low, that shouldn't matter for your long-term portfolio or a long-term loan, or whether or not you should buy, a long-term sort of product like life insurance. That's an assumption on my part. I think it's a pretty good assumption given what we know how markets work, but we can test this, right? So the first thing we can do is we could directly test the predictive value of one day's financial information. So we can take the market conditions for one day and see how it predicts stock market returns. It's even just, can it predict itself a week in the future, a month in the future, 6 months, a year, 2 years? The other thing we can do is we can drop extreme days. That is, we can drop the top 1% and 5%. We can also, I think we've also done 10% of days in the sample. So days when the market moved a lot. There are these days where there is marginal information on a given day, right? A stock market crash. And the day that happens, there's a lot of marginal information that affects long-run financial things. But these things tend to be rare. And so if we're worried about there being information in these days, we can simply drop the days for which we expect there to be the highest amount of information. We can see whether or not the coefficient shrinks or is driven by these days. The second part is we have to sort of figure stuff out on the supply side. So imagine the insurance companies knew this. They knew that there was demand shifted with stock market volatility. They could raise prices on days when they think demand is going to be higher. Or they could have their salespeople work an extra hour to call more people on that day because they know it's easier to sell insurance. Right? We have to worry about supplier side effects. This is where the way that this insurance works actually saves us. The institution details do. So first, the prices just don't change. They change like maybe once a year. So they're clearly not changing in response to day-to-day stock market volatility. And so you're basically facing a fixed price over the course of the time period we're looking at, more or less. Advertising is also like that. They go for like these big advertising campaigns, again, change maybe a few times a year. So it's not something that's at the level of the daily frequency. And then finally, this is all demand driven. They actually don't have salespeople to go out and try to sell this insurance. They do all this advertising so that you'll call them and go to buy the insurance. And so there doesn't seem to be a supply response here. So it's going to be any change that we see is going to be all on the demand side. For loan officers, there's a few things here. The main problem is that we don't see the loans that they don't approve. So we have to assume that the loans they see in a given day are uncorrelated with stock market conditions. That is, if the portfolio of loans they see on a high, that they review on a high volatility day look different than the loans they do on a low volatility day, then that could be driving our results. We really don't think that's the case here for several reasons. You might think, again, maybe the firm's really smart and they know that it's easier to get a loan when the volatility is low. And so they only put in their applications on low volatility days. The reason that doesn't work is there's a long lag between when a firm files their extension and when it actually gets reviewed. One of the managers at a bank, one of these banks told us, like, if it's a month, you're lucky. So unless you're able to predict what something like volatility is going to be in a month in the future, you're not be able to do this. And if you can predict what volatility is going to be a month in the future, you would be very, very rich doing some trading. The other thing is that we might worry that after the loan officer gets the loan, or when the manager is selecting which loans to give, that's the margin on which it's changing. So maybe on high volatility days, the manager's like, I'm only going to give them easy loans to review today because I know they're going to be distracted at work. Or maybe the loan officers are going to think, this is a tough loan. I'm going to review it tomorrow when I'm not so distracted by the stock market. Again, here, the institutional details save us. China's one giant time zone, so there's no time zone variation. And so these assignments are given out at the beginning of the day, first thing, before the stock market opens. So the manager can't be responding to that day's stock market conditions because he doesn't know what they are yet. And the other one is that if you're assigned a loan to review that day, you need to get it done by the end of the day. That's just it. The manager's like, yeah, no, that would never happen. Like, you get a loan assignment that day, you need to finish it that day. So that they're telling us that the loan officers themselves don't have the flexibility to time shift when they do these loans. So again, we think that this means it's pretty much going to have to be the loan officers themselves responding to these conditions and not the set of loans that the loan officers review on any given day. Okay. So getting to the results, demand for insurance. Pretty simple, right? Log of policies sold by date and city, stock market returns for that day, stock market volatility for that day, city, day of week, week of year, and year fixed effects, and run that regression. So here, let's look at this column, returns, or this row. This is the impact on returns on sales, and no, there's nothing really there. The coefficient tends to be negative, small, and statistically insignificant. So stock market returns have no impact on the demand for insurance, which is what you'd expect. If the stock market goes up a little bit or down a little bit, that doesn't really affect your wealth, so why should that affect your long-run decision-making, like whether or not you should buy insurance? Volatility, on the other hand, has a large, positive, highly statistically significant coefficient. So this means when stock market volatility goes up, people buy a lot more insurance on those days. This is kind of neat. This is the result we're looking for, which is that when stock market volatility is high, insurance goes up. This is contemporaneous stock market volatility. The other thing, when we worked with this data before, actually for pollution, is that we actually combined 2 days worth of pollution, 2 days worth of stock market volatility, that day and the day before, because maybe the stock market volatility is high today, and you get home and you want to buy insurance, but you can't because they're closed, so you call them the next day. So we'd expect to see that. That's kind of what this says with these coefficients, with 2-day volatility is higher than just same-day volatility. If you don't believe that, it's still fine. You still see the result with just the same day. Yes?
So like, what happens if you look at the longer, is the transformation increasing level, or people just keep that demand today and then that's the same?
This is a good question. The harvesting thing, it doesn't look like in the window of about 60 days, which is what we've looked at, that there's harvesting. But we can't, it's really hard to rule out, right? So if there's just a minuscule amount of harvesting from every day for the next year, we'd never have the power to see that. So while the data doesn't show any clear signs of like time shifting and when you buy insurance, I don't want to be too strong about being able to rule that out. But yeah, that's exactly a very important question, right? Does this affect when you buy insurance only, or does it actually get people who wouldn't have bought insurance to buy insurance? I'm not sure. Other questions? Okay. Here's some robustness checks. You know, they're two sort of fancier measures of volatility than we use. They get the same results. And then we can sort of do stricter and stricter fixed effects. So I think by this time, it's week by year. So you only look at the variation within any given week. You still see it, the size has dropped like we'd expect since there's not that much variation. But even with that level of fixed effects, we still see something. This is my favorite one. So in China, there's a mandatory for insurance products, a 10-day cooling off period. So if you buy insurance and you change your mind in the next 10 days, you can cancel it for free. And so let's go back to my story, right? My story is the stock market volatility is high. It stresses you out. You become more risk averse. When you're more risk averse, you're like, oh, I need insurance. So you buy it. So what should happen the next day if stock market volatility drops off a cliff and it's just completely flat? I think maybe you're less stressed. And now you're thinking, why did I buy that insurance yesterday? The world's not that scary a place. And so now you can cancel it. And so that's what this looks at. It looks at, you look at stock, you know, how purchases are affected by stock market volatility on the day of purchase, and then you look at the relative change in stock market volatility in the cooling off period. So this here is just the relative volatility history. This, I think, is easier to understand. This is order date volatility. So, sorry, the dependent variable here is if you cancel during the cooling off period. So what this says is how volatile it is on the day that you buy doesn't affect whether or not you cancel insurance. What does affect whether or not you cancel insurance? Whether or not order volatility dropped relative to the date that you bought it. So if you buy it on a really high date and it drops, you cancel more. If you do it on a medium day and it drops, you cancel more. If you drop it on a low day and it drops even more, you cancel more. So this is kind of neat. This is pretty good evidence that this has to be something psychological, that's short run, that's being driven by volatility in the short run. Because you get not only the demand effect on the buying, you get the demand effect on essentially the selling, the cancellation. Okay. So next we'll move to loans. So remember, the key identifying assumption we have here is that the portfolio of loans that get reviewed on a given day is uncorrelated with market conditions. That is, you know, the bank is going to review 50 loans that day, and the 50 loans look exactly the same on average, regardless of whether it's a high volatility day or a low volatility day. Like I said, this is an assumption we make since we don't see the full portfolio of loans, but I think it's a pretty reasonable assumption to have here, given the things that we talked about, the lag, the way that they're assigned, and the fact that they need to be complete by the end of the day. Now, another thing here that's sort of explicit or implicit but hasn't been said is that the future performance of the loans are not affected by that day's market conditions. Right? Like if higher volatility today actually made loans fail more tomorrow or less tomorrow, that could be driving the effect. This is another version of the neoclassical story that there's some information inherent in that day's market conditions, and we can't have this happen. So that is an identifying assumption we have for the story I want to tell. We're going to try to test this more directly later, but just don't forget that bit, because without that bit, it doesn't hold. Okay, so the empirical model, again, pretty simple, looks more or less exactly like the last one, and instead of counts here, we have a dummy for distress. Oh, and the other thing here is we have a set of firm and loan characteristics, like the size of the loan, whether it's a state-owned enterprise, all these things. It doesn't really affect the regression too much, whether I add or delete these, so I'm not going to spend too much time talking about them. Okay, before we get to the results, this is just the raw data plotted. So this is every day, and this is the market return divided into basis points. And so, you know, you see there are a whole bunch of days here where it's sort of at 0. That means there are a bunch of days where none of the loans approved that day defaulted. And then these days where you have a higher level up here, these days are days when a higher share of loans defaulted. So this day here was a really bad day. 60% of loans approved that day defaulted sometime in the future. This graph sort of takes that and makes it look a little bit better. It divides everything or combines everything into basis point bins. The size of the circle is how many sort of loans are sort of in that bin. It's very non-linear, right? To me, when I look at this, it looks pretty symmetric around 0. That is, the worst days in terms of loans going to default are actually days when the market isn't doing much. And when markets either lose money or make money, then the default rate drops. So it's not like, you know, I actually expected to see a bit of an optimism effect. That is, when the market's doing well, maybe the traders are in a good mood. It's like the sunshine paper, right? Sunshine is people are feeling happy, and so they're more optimistic about the future. Maybe the stock market goes up, they're more optimistic about, oh, other companies are going to do well. We see almost no evidence of that. So I can take this and I can basically look at volatility, and we see the story we'd expect given the symmetric around 0 thing. Default is the highest when volatility is very low. And as volatility gets high, that is, you have these days of big gains and big losses, it goes down. So if you look at this, it goes down a lot. And then it, you know, it does some weird things there. But it goes down a lot, and then it kind of stays flat, kind of goes up. I don't know. It gets kind of crazy when you get to these smaller things out here. But clearly, excluding these extreme days, it's a very monotonic effect on loan performance and that day's stock market volatility. Just in the picture, right? So when the stock market volatility is higher, the share of loans that go to default are lower. When stock market volatility is lower, the share of loans that go into default are higher. What we hope to find, right? This is our prediction. Here's the math version of that, right? Univariate regression, so return volatility. If you look at just returns, there's nothing there. In fact, if you really wanted to put a sign to it, it's actually negative slightly. Volatility, though, is negative and large and statistically significant. So on days with high stock market volatility, the probability that a loan defaults goes down. We can add them together, we can throw in, and you see again that, this coefficient barely changes across these different specifications. These are just some leads and lags on volatility returns. With returns, we saw nothing in the main coefficient, so we see nothing in the leads and lags. With volatility, we see not much. We knew that there's a little bit of a lagged effect. We see it as not statistically significant. The lead shows nothing. So again, this says that it's short run, whatever this effect is. It's mostly contemporaneous. Maybe it lasts an extra day, but it's all loading on volatility and not returns. The thing that matters is how stock market returns look. Sorry, what stock market volatility is that day and not what returns look like. Which was a bit of a surprise for me. I expected both to matter. Okay. Some robustness checks. Again, we try the fancier measures of volatility than we use. It's all the same. There are different levels of distress. So the banks actually have 3 levels of distress. One is like you expect to lose like 50% of the loan. The other is like 50 to 75, and the other is expect to lose more than 75. So we can combine these in whichever ways we want. We can make, our default is we use the 2 main ones, so you're going to lose like 75% or more of the principal. We can make it looser, we can make it tighter. That's what you do here. If you make it looser, it actually has almost no effect on the magnitude of the coefficient. If you make it tighter, it gets about half the size. But there are very, very few of these really, really bad defaulted loans. So I'm guessing it's more of a power thing, but again, it all loads into volatility. Here's something interesting we're going to come back to later. These are the truncated samples. Right? So these are the samples where I throw out days with the highest 1% of volatility and the highest 5% of volatility, which also happens to be the highest 1% of returns and the highest 5% of return, because I'm using the very simple measure of volatility, which is return squared. Remember, here's my coefficient. My coefficient of distress is around -8. When I truncate the sample, the coefficient gets much, much bigger. So this means that the action isn't being driven by these extreme days. In fact, something weird is happening in the extreme days that counteracts what's happening most every other day. And I think you can kind of see that in the picture, right? This looks like a nice, clean downward drop for the first, 10 or so of these. And then it starts going crazy. And a lot of these seem to be higher than this trend would expect. And so we see that in the data too. When we cut these ones off and focus just on this part of the graph, you get a much sharper and much bigger negative slope. So this is kind of interesting. It says that it's the ordinary days that matter a lot, and it's not these extreme days that you'd expect if this were an information type story. Because it's exactly those extreme days that you'd expect there to be potentially some information that could affect long-run financial planning in sort of a neoclassical rational fashion. The last 3 columns are just the exercise we did before, where we do stricter and stricter and stricter fixed effects, so they get shorter and shorter and shorter. And we see that it survives even the week by year individual fixed effects. Okay. So hopefully I've convinced you by now that when volatility goes up, loans perform better. That is, the portfolio of loans approved on days with higher volatility perform better than those that are approved on days with low volatility. So what if we look at the loans themselves that are approved? What do they look like on high volatility days versus low volatility days? And what we see here is, again, returns don't seem to matter that much. But if the volatility is high, the average loan size is bigger. This was something we thought would matter, which is some of these are sort of done at these small branch offices, and some of them are done at the main office. We thought there might be like a country city kind of difference. There wasn't. State-owned enterprises. So on high volatility days, the companies are larger and less likely to be a state-owned enterprise, which again would go with the intuition that state-owned enterprises are not the better companies or the better run companies in China. And then they have their own internal credit rating. And so this was the one that was maybe makes the most sense, which is kind of the most shocking. This is the thing that one would think almost all of their decisions should come to, is the internal credit rate worthiness that the bank has decided to bestow upon the company. We do see that this moves a lot. So basically on high volatility days, the portfolio of loans that get approved are for companies that are borrowing more, are less likely to not be state-owned enterprises, and have higher credit ratings, which would go along pretty well with the fact that these are the better performing loans, because you're making them to bigger companies that aren't state-owned and that have higher credit ratings. Okay. Now we go to the number of loans approved, right? So maybe all this performance difference I'm talking about is, and there's a literature in psychology that says when you're stressed, you actually perform better. And it's like, I don't know, like you're being chased in the olden days by some wild animal, and so you have to learn to make better decisions or you die. It's an evolutionary thing. I don't quite know. But there is some evidence to suggest that stress actually helps you make better decisions in certain cases. So maybe that's all that's going on, right? Maybe what happens is on high volatility days, you're worried, maybe you're worried you're going to get fired, so you actually work harder and you make better decisions. So there's actually no change in the number of loans approved. I don't know. On the other hand, if I'm raising the threshold for which loans get approved, I would expect the number of loans that get approved to drop. That's a risk aversion story. I'm not making a better decision. I've just put my cutoff higher for whether or not to say yes to a loan. Okay, so number of loan approvals. This is by day. So when volatility is high, you approve fewer loans. You approve fewer loans overall. But if I focus only on loans that I know eventually default, that's where all the action is. Right? So on high volatility days, I approve fewer loans, and most of the loans that on higher volatility days, I approve fewer loans, and that reduction in loans that are being approved are almost all driven by high volatility or loans that were destined to fail. That is, my reduction in loans is almost all driven by reduction in loans that would have eventually failed had I said yes to them. So this is kind of what you'd predict. This is exactly what would happen if I increase my threshold, is I would drop the loans, but I'm not approving fewer loans on random. I'm approving fewer loans exactly on the margin of failure. So I'd expect that to lead to a decrease in the number of failed loans. Okay. So all of this, I think, is pretty consistent with what I've talked about before, right? The psychological term is emotional carryover. I'm just going to call it, we have risk preference that goes across all domains. And so a visceral response we have to volatility in looking at the stock market doesn't just affect our thinking when it comes to risk aversion in the stock market, it affects our risk aversion period. It's like the scary movie increasing risk aversion. Here, the scary movie, the stock market's going crazy. That increases your risk aversion in other domains that have nothing to do necessarily with the stock market. Okay. So that's what I'm going to try to convince you of, but I also need to rule out the two main other hypotheses. One is there's learning here, or there's some information here. There's something to be learned. with that day's stock market conditions that are going to affect things in the future. The other one is behavioral, and this is the distraction hypothesis, right? So if I'm distracted at work when I'm supposed to be approving loans, I put forth less effort, and when I do less effort, things can happen. Like I just take the loans that are hard to approve and just toss them out. We're going to talk both of these in a bit, but let me try to convince you of our hypothesis first, right? There's actually kind of a rich literature in the lab on things like emotional carryover, and that we have pretty good evidence here. You know, I've already talked about the Lowe paper where they've done skin conductance. They actually had a follow-on paper where they found similar results. And then there's this paper where they basically took experienced traders in Europe and they primed them with the financial bust and then sort of saw what they did in the lab, and priming them with the financial bust made them more risk averse. And then this one, I want to just mention really quickly. This one, they find when the stock market drops, people have more heart attacks. But they say this isn't a behavioral response. They argue this is a purely rational response, which might make sense in this setting, right? So if you have a lot of stuff in the stock market and there's a big drop, and we know that there might be momentum here or something, that basically you're just projecting stuff out into the future, and when you do that, it looks really bad. But it all loads on returns, because volatility doesn't affect the size of your retirement portfolio, but gains and losses might. And so they actually have this as an information story, which is why we need to sort of rule it out in other cases. I think the first thing that helps us rule it out, if we don't find anything with returns, we load all on volatility, which has much less to do with the value of things like your retirement portfolio than returns do. Okay. So this is the one that I think is kind of the closest in the terms of, this is the experiment where they subjects exhibited increased risk aversion if they're shown a brief horrifying scene from a movie. And so if stock market volatility is the horrifying movie, again, predictions, risk aversion goes up, you buy more insurance. Risk aversion goes up, you increase your threshold for approving loans, so you approve fewer marginal loans, right? The ones right at the margin, so there are fewer loans approved. The loans that you do perform or you do approve perform better, and they just look better on paper. And this is exactly what we find. Okay, so can the neoclassical learning, broadly defined, explain this? So it could be that there's relevant information about the future contained in that day's stock return. And as I said at the very beginning, I don't think it's likely, but we can test it. I'm going to show you that in a bit. And again, maybe there's something like, I don't know, 9/11 in the US. That was a day with high stock market volatility that also probably affected some businesses' ability to pay back loans, right? So, but all of those things are extreme days. So we can sort of take out some of these extreme days and see what the results look like. See if they're driven by these extreme days, which are going to be the days for which there is the most information or the biggest common shocks. Okay, so first, is there information in daily volatility? Well, no, there isn't. So you can look out for a period of 1 month, 1 quarter, half a year, or 1 year, and the coefficient tends to be small and statistically insignificant throughout the entire range. So volatility does not predict returns even 1 month into the future. Returns, on the other hand, do predict returns. This was the Parson-Engelberg paper, right? For at least a period of a quarter, stock market returns predict stock market returns. This is something we know. It's not strong, it doesn't last long, but it's still there at least. But again, if there's information there, it should be loading on returns because that's where the information is, and that's exactly where we don't find it for null results. It all loads up on volatility. And returns aren't the thing that makes your heart race. The thing that makes your heart race is when the stock goes up and down, up and down, up and down. But volatility has no predictive power in stock market returns. That is, today's volatility has zero ability to predict stock market returns a month from now. Whereas today's stock market returns actually can do a pretty good job of predicting returns a month from now. Yeah. I see. So you think it's would it be fair for me to call it a mistaken beliefs, right? Yeah, so even though we know that there's no information here, people believe that volatility predicts stuff in the future. And so when they try to figure out whether or not they should buy life insurance or whether or not they should approve this loan, because volatility is high, they think it's going to be, yeah, no, it could be that. But that wouldn't be a neoclassical story. That would be a behavioral mistaken belief story, right? Okay, we'll come back to that, I think, at the end. That's a good one. That's a good one. Then, I said we're going to come back to this later. These are the truncated samples that I showed you before, real briefly, right? If it's these sort of large shocks that affect both the stock market, if it is like them to like 9/11, affects the stock market and affects your ability to pay back loans and affects your probability of death, right? We would expect it to happen on these extreme days. These are also the days where there's probably the most information. So it helps with both of those sort of channels that we might worry about. And we find the exact opposite of what we would expect, which is that when you truncate these samples, you actually see a bigger, this is for insurance. We don't see much of a difference. So for insurance demand, when I truncate these days, it looks about the same. So that doesn't seem to matter. Whether or not you have these high volatility days, these extreme events don't seem to affect life insurance that much. This is the one I was thinking of. This is the, this still isn't the one I'm thinking of. This is volatility on cancellations, right? So if I look at sort of the extreme days, if I get rid of the extreme days, the effect on cancellations is much bigger. That is, if I have a crazy day and volatility drops, the effect is unclear. But if I have a regular high volatility day and then volatility drops during the cooling off period, I'm much, much more likely to cancel my insurance than if it's a crazy 9/11 day and then volatility drops. So it does seem like these extreme days are different, but not in the way that's consistent with information or common shocks. That is, if it was driven by these extreme days, we'd expect this coefficient to get smaller, not larger. Right? These extreme days actually attenuate the effects that we find. And the same thing here with loan default. This is the one I was originally thinking of, right? If we look at loan default, if we get rid of the extreme days, the effect size gets larger. That is, this effect isn't driven by these big, potentially momentous information containing days, it's driven by the ordinary. And that these crazy days actually throw a lot of noise into there, actually makes the result look smaller. They attenuate the result, they don't drive the result. So these extreme days are different, but not in the way that's consistent with the story of information, of learning here. So there's an alternate mechanism that we've given a lot of thought to because people seem to really like this, but they like it only for one of our two results. The idea that there's distraction. right? One of the things I mentioned at the very beginning is that managers are really mad that their workers are doing on-the-job training. And so if volatility is high, those are exactly the days when you want to spend more time on your phone when you're day trading, because those are the days that you want to, things are going up and down, you want to check. So maybe all that's going on is that when volatility is high, they're putting forth less effort. And so that's what's driving all these results. Now that works for the loan officers, right? The loan officers, it's plausible in that they put forth less effort. So then the loans that are hard to evaluate, the ones exactly on the margin, are the ones they say no to. But the story gets pretty convoluted pretty quickly, especially when you, so for the loan officers, they get distracted, so they do less work, whereas consumers, they get distracted, and so they do more work by going out and buying insurance. It doesn't quite work there. And I'm going to go to a little bit more information on why we don't think this works. The effect is also nonlinear in the wrong direction. Is one of the other pieces of evidence against this, right? So I would assume on the really, really top 1% high volatility days, those are the days where you expect people to be the most distracted, right? That's when you're spending all your time on your phone, or the top 5% of days. But remember, when I do that, the coefficient actually gets bigger. So it's not driven by those days, it's attenuated by those days. So if it's a story of distraction, you have to say people are distracted when volatility moves a tiny bit, but they become less distracted when volatility moves a lot somehow. You can come up with a story like that. Maybe they just give up. They say, oh, the market's too crazy today, I'm just going to do work. Like I said, you can come up with these stories, but they start to get pretty convoluted, especially when you have to combine both the life insurance and the loans and the fact that it's nonlinear in the wrong direction. That is, the effect is smaller on these days. You'd expect people to be more distracted. The other thing here is that, and this I just realized preparing these slides. If you're getting rid of the marginal loans, right, the ones right at the margin, you should be getting rid of both some good loans and some bad loans, right? Because you're just getting rid of the loans that are hard to evaluate. But if you remember when we looked at the drop in the number of loans, there's only bad loans that were being dropped. That really doesn't look like skipping the hard ones. You're only saying no to the hard ones that are riskier, right? So imagine in your head, here's my threshold. If I move it up, I've gotten rid of all these loans here. And so they would all be only bad loans. Whereas if here's my threshold, but I'm not moving it, and I get rid of the hard to evaluate loans on either side of my threshold, these are the bad loans and these are the good loans. Just to get rid of some of both. And I don't. Again, none of this is airtight, but all of this is sort of pretty good suggestive evidence that this isn't distraction. And I think as a whole, it combines some pretty convincing evidence it's not distraction. Okay. So I want to get back to the belief story now, because this is my plea here about other things to ask or other ideas to have. So mistaken belief. So it could be that when I see volatility, I believe it's going to make things worse in the future. So it's not my risk aversion that's going up. It's my expectations on the future economy that's going down. Is that distinguishable? So if it's the economy that's going down, I would buy life insurance. Why would I buy life insurance? Because it's a safer thing to, right? I could see it for the loans. Does it make sense for life insurance? I guess to the extent that life insurance is an investment? Maybe. Maybe. I guess for that, we could look at other insurance types that aren't investments. Right? You wouldn't expect to buy more accident insurance if the market's going bad, would you? Maybe you'd even buy less because the price of everything is going to go down. It's cheaper to repair. I don't know. I got to think about that. The mistaken beliefs are really tricky. I had a paper where someone thought that this was what was going on. And so we went out and we did a survey of the people in this market to see if they had this mistaken belief. And they didn't. And I think the response from the person who originally had the belief story was something like, but they could still think it even if they don't say it in the survey, which again is true. But I guess at that point, it almost becomes sort of isomorphic as to whether it's beliefs or preferences, right? Yeah, this is always a tricky one. This is a good one. Beliefs, the difference between beliefs and preferences tend to be so hard to disentangle if you don't believe people's stated beliefs. But I'll think about that one. Okay, I'm actually at the end. So to summarize, the empirical finding we have is that daily stock market volatility affects decision making for consumers and commercial loan officers. And the effect sizes we have are meaningfully large, I think. Right? A one standard deviation increase in volatility increases life insurance purchases by 2.5%. It decreases overall loan approval by 0.7%. But since it's all sort of loaded onto bad loans, that this 0.7% decrease is all driven by these bad loans, we actually see an 8.6% decrease in the probability of default. It seems pretty good. That's a big wedge in terms of the shares that you have defaulting. And so this seems pretty good evidence that stock market conditions affect long-run financial decision-making of both consumers and financial professionals. The result, I fear, is most consistent with fear-induced risk aversion. This is what Andrew Lowe and co-author found. Like, volatility makes people stressed, and when they're emotionally responsive, they sort of get all sweaty. And when that happens, they act more risk averse. And I think that that's basically what we're finding here. And I feel we can pretty effectively rule out rational choice in learning. I feel good at this point about distraction. I'll need to think about mistaken beliefs in this context. And if you guys have any other things, this is very helpful to be able to get ideas that we haven't thought of to try to be able to rule them out. And so I think one kind of neat thing here is it provides evidence of a feedback loop through which the stock market affects the real economy. Right? There's a sense in which the stock market isn't the economy. It's sort of a sideshow, right? It's not what the real economy is. But if stock market volatility affects how people approve loans and affect how they make long-run financial decisions like insurance and other things like, I don't know, buying a house or buying a car, then you could see how stock market conditions could actually lead directly to changes in the real economy that have nothing to do with the value of the stock itself. And I think another thing here that I haven't talked about before is one thing that's really neat is that our result isn't just about these big events, right? A lot of the stuff that sort of came before that sort of looked at this that I cited, they were talking about financial crises. You prime someone with a bust and then they get more stressed and they act more risk averse. Or the financial crisis happens and the entire financial world collapses or comes close to collapse, and then that causes people to be more risk averse. This isn't that. This is the opposite of that in the sense of that's not only not driving our results as extreme events, they actually work against our results and attenuate it. This is about the day-to-day, the ordinary volatility in the stock market. And it says that volatility has a huge effect on how people perceive risk. And if that has a huge effect on how people perceive risk, well, that should feed back again into how they do things like value stocks versus bonds and stuff. And it might go some small way to explaining, the too much aggregate sort of risk aversion that we see in the stock market. So that's all I have. Thank you.
So now we are open for questions for both.
Like do these results that the higher stock market volatility leading to the like greater risk aversion mainly holds on the day that the stock prices are declining? I would have thought that okay, if the higher volatility coincides with the rising stock prices, that might lead to greater optimism. And yeah,
I get this a lot, right? And I was on the same bandwagon you are, right? So that, you know, part of it is you should expect if the stock market going up makes you more optimistic, then your threshold, your bar drops, makes you more pessimistic, it rises. So not only would you see this nonlinear effect of volatility, there should be some line here as well. And we just don't see it. It's just not there. I find it really surprising. The other thing too, which you mentioned briefly is, you know, maybe you'd expect there'd be an interaction. So the volatility would have a bigger effect when things are crashing and going down. It should be much worse for you than when it's going up and going down. And again, we just don't see it. I don't know. The ex post ad hoc explanation I came up with was that it's FOMO. It's fear of missing out, right? So if you own stock and you see it crashing, you feel really bad. But if you don't own stock and you see the market going up, you feel really bad. And those effects are sort of cancel each other out. And so that's why we see it not mattering so much. You don't own that stock. You feel just as bad as if you own the stock and it's going down. Because remember, this isn't about your actual financial situation. It's not about the returns. It's about your feelings. And if you feel bad about missing out, you know, just as much as you feel bad about having lost some money, you would expect this not necessarily to have this positive relationship that ex ante I predicted.
Okay, so it's probably not the question, just a comment on the what you call the misbelief. I think maybe there are another story on that part about the volatility that might be consistent with the neoclassical, right? I mean, because you test that volatility does not predict the future return. But I mean, in the day that you have higher volatility, it could become more uncertain. Like you could have the higher variance. Maybe the average return is the same, but the variance in the future increase. Yes. So in that case, it probably makes sense for the loan officer to be more careful, right? But I will admit that it could not explain why people buy more life insurance.
Yeah, I guess. Okay, so since we ran this test, instead of having the dependent variable be returned, the dependent variable was volatility.
Yeah.
I think we might have had that at one. Okay. No, he's saying it's not. He's saying it could even be consistent with the classical story of volatility. Like I'm saying, it doesn't affect the mean, but he's saying maybe volatility signals that the market's going to be more volatile in the future.
Yeah. So but I would admit that it would be difficult to distinguish between higher risk aversion and higher risk, right? Because we all observe the behavior. Yeah. So it could be difficult.
And to the extent that people take higher risk in the stock market as higher risk in life, that might also increase.
But I think the life insurance will support your cost because it's quite difficult to link between the higher risk and why people should buy more life insurance.
Yeah, I agree with both those points.
Hello. I think the stock market volatility is also correlated a lot with other factors as well, right?
Okay.
Like, for example, like what you said, terrorist attack or maybe climate change and things like that. And you have done some tests, right? You rule out that this is probably not the case by kind of like dropping samples like those extreme days, right? But still there are some other things, right? That might be correlated with the stock market volatility, and that might also affect decision making as well, right? For example, I mean, climate change might not be that extreme in that day, but it also affects the decision making, right? So if you want to say that it's really this like stock market volatility, the stock market itself, not something else, right? I would kind of like expect to see your results kind of like more concentrated in a sample where, you know, these people hold some portfolio in the stock market, something like that. Because like these people would kind of like follow the stock market, right? And therefore they would make decisions based on the stock market. But if I don't hold any stock at all, right, then I might not be affected by this stock market volatility. Would that make sense?
It makes perfect sense. This is actually something we tried to get. We couldn't get the portfolio of the loan officers. But the other thing is, you know, is the thing we said before, the fact that there's no sort of linear component here suggests that when the market does well, you also get stressed, which if it's fear of missing out, it's because you don't own the stock and the stock market goes up that makes you feel bad. So it could be, it's not just what's in your portfolio. What's in your portfolio would only affect you on the way down. What's not in your portfolio would affect you on the way up. But I guess we could construct both measures if we had people's actually portfolios, but we don't. But you know, point well taken. I like that. Like, if you could get people's stock market portfolios, I guess you could still push back one other level and say their own personal stock market portfolios are correlated with something that's correlated with the shocks that affect just them, right? So regional bias, right? People buy stocks that for companies that are near them, and so the fact that shocks are regional, you could see it affecting both of them. So I agree. It takes the argument one step sort of further, but you can always take another step and say that you know there's still possible correlation, reasonable correlations there. And this is the thing is, you know, short of an experiment or a clean instrument, it's always impossible to rule out these common shocks, right? But yeah, no, your point is well taken. It could still be something, you know, it could still be something that in these sort of average kind of days, that there's still some shock that affects your demand for, makes you think the world is a riskier place, or makes the world a riskier place, and so you buy more insurance and you buy more. Yeah, no, it's true.
So for the just clarifying on the life insurance, it's just like only when the payout is only when you die, or is it one of those life insurance like we have in Thailand, like you get annuity after, or?
I think most of it is the second type, right? So it's there's an annuity component at the end, not for all of them, but for a lot of them. So they have both types in here.
Okay. Yeah, I see. So
and you can think of it as, you know, not just, you can think of it as a long run savings investment, right? But as long as it's a long run thing, I think we're still okay here.
Okay. Yeah. So I was thinking of the story, like if you're in like a high volatility regime and you have like perceived return of the stock market as low, maybe you want to invest in like the.
Yeah, no. So, you know, if it's all beliefs, I think it would look, if you believe that the world has gotten more risk averse from short run volatility, right? You can't tell the difference between the world being more risky and you being more risk averse. They're sort of working the same. So beliefs that change your level of how risky the world is would work exactly the same as if I shifted level of risk aversion for the most part, right? So that's a tough one to sort of figure out. I guess one thing one thing, again, it doesn't actually answer the question, but it moves the goalpost one step further out, is we could do the survey again where we sort of ask people their perceived level of how risky the world is, and then do the survey on a whole bunch of days and see if it correlates with that day's stock market volatility. And if it does, then it would seem like their beliefs are affected by stock market volatility. And if it doesn't, I think, it's that might prove to be some evidence. I actually like that idea.
And I guess another idea, I don't know how like the data looks like is there like a regime of high volatility at one time and then low or whatever, but I guess if you notice like certain like high volatility and you aggregate, like do people buy life insurance over that period, like the aggregate life insurance? So I guess taking the high frequency into like lower frequency data, do you see like sort of the same thing?
So we see lags of maybe a day. So yesterday's volatility has a small effect on today's life insurance purchases. 2 days ago doesn't. So the effect seems to be really short-lived.
Okay. Well, I'm guessing like if you look at over a month, do you see anything like the amount of life insurance in that month with this month with very high volatility?
Are you thinking, what are you thinking here? Like going up, down every day for 2 months is different than down for a month and up for a month?
Right. Well, or yeah, like very high volatility in a month, and you characterize that as like a high volatility.
Yeah, so given our results, we'd expect the one low month versus one high month to have higher insurance sales than up, down, because yesterday's volatility matters. So for the up, down regime, on a high volatility day, yesterday's volatility was low, so it's only today that matters. And the next day, I get a little bit of the carryover. Actually, no, it should be the same. Never mind, because on the low volatility day, I get the carryover from the high volatility day. Yeah, so it should matter for it shouldn't matter for purchases. It would show up in potentially in cancellations, depending on how exactly cancellations work during the 10-day period. Yeah. That's another good thing to check.
Oh, สามารถเปิดไมค์ได้เลยค่ะ So we have a question from online audience.
Okay. Thank you very much. I have a questions about the nonlinearity of volatility, because according to the result, we can see that dropping the extreme days have impact on the effect. So there's a, let's say, effect when volatility makes you sweaty and performs better on loan, but on the other hand, when the volatility is high enough, they kind of make the officers freaked out. So there's a, I want to know about the trigger which make the effect switch, and I want to ask about the implications for let's say bank supervision, because usually in bank supervisions we assume that the default of loan for bank is constant all the time, but if the result of the case here is kind of suggest that bank will look more unhealthy during the normal periods of not normal periods of high volatilities. But so in let's say high normal volatilities, the bank will kind of look unhealthy. So the kind of increased cost of supervision, because as a regulator we'll see, okay, banks is going to be unhealthy during the high volatility period, but actually banks kind of healthier than we expect because of the volatility effect.
Yeah, there are two things here. One is, these are the days where I expect people to get really emotionally affected by stock market volatility, right? But we don't see an effect. And I think the answer to that is not that when the stock market goes crazy, they stopped responding. I think on days when the stock market goes crazy, there are lots of other things happening too. Those are special days. And given that they're special days, all kind of crazy things can happen. So maybe what happens on these days is they start like randomly rejecting or approving things, so they're just so distracted or something, right? It just says that, you know, these days are special. The extreme days are special, and the results we have aren't driven by these special days. That's the main thing I wanted to take away here. The other thing you have is really important, right? Which is, what are sort of the welfare implications here? Like for this bank, if they had simply shifted and had the workers do more work on high volatility days, they would have done much better with their loan portfolio. Well, there are a couple things to be careful about here. One is that I don't know what the right level of default is. What's the optimal level of default here? Maybe they were at their optimal level of default, and by decreasing default, they moved away from their optimal level of default. So without knowing what the optimal level of default is in any given situation, you can't figure that out, right? And the other thing is, you know, in this case, just looking at you can do the math, and at least financially, it looks like the banks would have been better off on a purely return sense if they did follow that policy. But then there are other banks where maybe what's going on is their loan officers already have too high of a bar. And if they actually lowered their bar, they would simply, or sorry, if they raised the bar, they would simply be saying no to good loans only. So let's take an extreme case where 100% of the loans that a bank approves get paid back, 0% default. Well, if those loan officers get even more risk averse, all you're doing is getting rid of bad loans. So the welfare implications are really tricky here because, you know, it depends on a lot of things. Welfare things are really hard to say, and really without you being able to tell me what the optimal level of default is, I can't tell you whether this is good or bad. Right? Maybe if they wanted a higher level of default, they wanted the bank to take more risks, maybe the right thing to do is move these over there as opposed to the other way around. But yeah, no, it's a very good but a very tough question.
Yeah, thank you very much, Professor. That makes a lot of sense.
Any other questions? Okay. So thank you very much, everyone, both the participant here and from home online. And thank you, Professor Chang, for today's very lively discussion and the talk. Very insightful. So yeah, please give a round of applause to Professor Chang together.
Thank you for coming, everyone.